Welcome to the Estates Made Simple podcast with Jenna Carvello and Gordon Vanderleek. We are on a mission to simplify the world of estate administration, helping executors gain the knowledge required to manage an estate. Please note, the following is for informational purposes only and is not to be considered legal, tax, or financial advice. We recommend you seek individualized advice for your unique situation with qualified professionals.
Welcome to another episode of Estates Made Simple. I'm here with my co-host Jenna Carvello of Guardian Estate Company. My name's Gordon Vanderleek of Vanderleek Law, and we have the delight every time we do this recording to talk about one of our favorite topics, which is all things related to estate administration. And we started this podcast to share some of our insights and our information with a view that it might be helpful for other people. So if you're listening or watching on YouTube, thanks. And we appreciate your support. And today we get to talk about working with charities or beneficiaries that are charities. So this is a situation where, let's be clear, this was only going to come up in the context of a written will. There would not be any charitable donations as part of the estate plan if you don't have a will. So interestingly, as a way to introduce the topic would be, if you're thinking about benefiting a charity as part of your estate plan, you need to have a will because there's nothing in the default rules that suggests that it should be, or that a certain percentage or a certain amount of money is going to a charity. It could be that your beneficiaries take their inheritance or what they receive and donate to a charity in your name. But if you want to give it as part of the estate, and there's some tax advantages for that, then it has to be part of the will. So the situation we're talking about is an estate where you have a charity, so like an institution, an organization that is part of the estate, and they're beneficiaries of the estate in some capacity. So what are executors' responsibilities? What are the rights that those charities have? And we wanted to explore that topic a bit. And I think by way of background, what I'm seeing, I would say over the last 5 to 10 years, but even more so in the last 5 years, an increase in the number of estates where there is charitable giving. So I think that's a good thing. I think in general in Canada, we're generous people and we do a lot of charitable giving, I think, compared to other countries. And interestingly, I think in the West, in Alberta in particular, if you look at the stats, we're, I think, right up there in terms of the top provinces contributing to registered charities in Canada when compared to others. So it's likely that executors may be faced with dealing with these organizations in terms of a proper administration of the estate. So we wanted to review some tips and some best practices in relation to dealing with charities and having a successful administration.
Yeah, I would say the first tip that has given me success in prior files of dealing with charities is finding the representative within the charities that actually deals with the estate administration. Typically, there is a department specialized in reviewing the bequests made to charities, and you want to talk to that individual because they might have additional questions. They might have a different mailing address, different requirements of what you need to provide to them. So to get a hold of them is important, not just to send your accounting to the general mailbox within the charity, not necessarily knowing if it's getting to the right place. The other thing that I think should be discussed almost right off the bat when an individual passes away is if the charity is willing to accept assets in kind from the estate in lieu of in cash, because there are certain tax benefits for transferring assets in kind to charitable beneficiaries. And so if you have that discussion first, then you're able to determine what assets should be kept within the estate until such time you are able to make a distribution. So there could be marketable securities you want to hold on to, even if they are fluctuating over time. Maybe there's private company shares. I know some charities actually accept private company shares as a donation, which is not commonly known. Maybe there's artwork that they'll take. So it's important to really talk to them about that, because it could significantly affect the tax status of those donations and impact the value of the estate for the beneficiaries.
And I guess the reverse of that is also true, that if there's those opportunities that exist and you're not exploring those, then there's some accountability to the beneficiaries of, why didn't you save the capital gains because you donated publicly traded securities, right? And if you don't have an answer for that, Maybe that gets you into a little bit of hot water. I'm looking at it maybe from a legal perspective and what could go wrong. So I like that notion of doing that early. I think that's great advice, but you don't want to delay on that. So yeah, to summarize, you want to find the right people. And that's been my experience too, is that oftentimes, especially maybe smaller charities, they'll contract out to third parties. They're not big enough and it doesn't happen often enough that they have somebody on staff whose job it is to manage the bequests or the interests in estates. So they might just hire somebody to do that on a contract basis, right? So just finding that person and then who the decision maker is, right? So you're getting it to the right place, but ultimately, if you're looking at doing a distribution in the estate and giving them their gift, you're getting to the right person because you'll need some decisions to be made on that. So because of some of the tax consequences, obviously this podcast is, we don't have the time, nor would we suggest getting to the intricacies of the tax rules relating to charitable giving. But suffice it to say, there are a bunch of rules relating to that. And you want to get advice on how to maximize the use of those rules and to comply with those rules so that it's a net benefit to the estate and you're exploring all the options. And I agree with you about the discussions with the charity early on. I've seen that in a number of cases that if you're ready to do a distribution and then you start the conversation, well, it may take you 3-4 months to work out a distribution in kind when you think, okay, that should be easy. They'll just accept it. But especially larger charities, there's a whole bureaucracy. There's a whole ladder of decision making. Maybe it has to wait till the next board of directors meetings to approve and the executive director's on sabbatical and all sorts of things could happen that would delay it. So the earlier you start in the process, the better. But in relation to the tax rules, just also bringing the accountant in early on to give advice on what are those rules, because they also do change from time to time. If you're here, we're recording in 2024, but if you are listening to this and it's a number of months and years later, there may be a budget and the federal government changes the rules. These are rules contained in the Income Tax Act, and they're subject to change from time to time. So you want to make sure you get the latest information from a qualified professional in that regard and get them in early. The other, I guess, item to talk about is providing regular and complete accounting. If you're dealing with a sibling as the beneficiary of mom's estate, oh yeah, they're pretty chill about everything and they're trusting me for everything. That's not the attitude to take if mom gave 10% of the estate to the local church or made a donation of a fixed amount of money, say 25, or giving money to the Canadian Cancer Foundation or some other charity. So from that perspective, if the charity is a residual beneficiary, they are entitled to receive an accounting of what you've done, right? We're going to start with an opening balance. And you're going to get to a point where you're ready to do a distribution and the lawyer and the accountant say, yep, we're ready to do a distribution subject to a holdback. And you're going to propose a distribution to the beneficiaries, which could include the charity. And they're entitled to look at every line item on that financial report, all the debits and credits of the estate. And you cannot assume, and nor should you, that they'll just be thankful that mom gave them something and not question anything. Like they see it as sort of accountability to their organization, whoever's job it is to review this, is to scrutinize it. Now, hopefully there's that element of perceived generosity for receiving the gift, but they can't just not examine it. That's part of their responsibility as a beneficiary to say, is everything okay here? And they're looking for the problems. Is everything appropriate? And so doing the financial reporting can be more complicated. So just be aware that in my example, you're dealing with siblings and the charity. The charity may take a very different approach compared to your siblings. And you just have to be ready for that. It's hopefully not a problem and everything goes smoothly. But I've been involved certainly in situations where the charities are asking questions. And my client, the executor, says, how dare they ask any questions? I have to say, actually, they're entitled to ask those questions and you better have an answer for them. So hopefully that means we're preparing well and we're providing good information. So you want to be complete with your accounting, which is something we've talked about in other podcast episodes of the importance of doing that. But in addition to that, I would also say do it regularly. You better believe that they're going to be marking their calendars with a bring forward date to say, what's going on with this estate? And again, in my example, maybe your siblings are a little more chill and go, whatever, we'll get it when we get it. Keep them informed. Let them know what's going on. If you get to a point, we talked about the executors year, and if you're not ready to do distribution, communicate to them why you can't distribute. and just don't assume they're going to be passive. They have all the same rights and privileges associated with being a beneficiary of the estate, and therefore you need to treat them accordingly.
And I think too, there's a difference, as you mentioned, Gord, between a residual charitable beneficiary and a charitable beneficiary that's maybe receiving a lump sum, so a legacy or a legatee beneficiary. If they're receiving a lump sum, then they don't have the same rights and responsibilities of reviewing all of the accounting. They can't ask the same questions to the same extent. And so, as you're undergoing your own estate planning, you may consider what's best for your own estate. Do you want a charity to receive a lump sum, that there's no negotiation, no questions, simply a check at the end of the day? Or do you want them to be involved with reviewing the accounting and receiving a percentage? And I would say there's benefits in both sides, because sometimes having increased oversight from a beneficiary perspective is a good thing. You want the executor to be held to a high standard, and you want someone who knows how to look at estate accounting to ask those questions. So just consider what's best for your own estate when you're doing your planning.
I think that's a great point. And I think a bit of the trend I've seen anyway is that a lot of people are moving towards having a fixed amount to simplify it for the family in terms of dealing with the accounting and all the rest of it. And typically that gift to the charity as a non-residual beneficiary could be made sooner. We don't have to wait for the estate, assuming there's sufficient funds and there's not a worry about liabilities or enough money to pay the bills in the estate. So the estate is solvent. That will allow that check to go out quickly, which can be used obviously in the filing of the tax returns and some tax benefits associated with that. With that being said, the problem with a fixed amount is, especially if it's a generous gift, but then the estate plan is not reviewed regularly, it may start out as 10%. I used that in an earlier example, so I'll continue with that. Let's say mom's drafting her will and says 10% to the church or a charitable foundation and the balance to the kids. In her head, when she's doing the will, she probably has a notion of, I have this much to give away. So 10% represents about this amount of money. But what happens then if her estate goes down because there's other expenses, or she's at that stage in life, moves into a care facility, needs more healthcare support. And so now she's spending more money every month and now her estate's going down. That's pretty common, in fact, that expenses at the later stages in life do ramp up. So the nice thing about a percentage, that if you had $1 million estate and a 10% gift is $100,000, what if the estate goes down to $500,000? If you gave $100,000 gift of a $500,000 estate, now that's a much different percentage than of the $1 million. So the advantage of the percentage is that if the pie goes bigger or smaller and it contracts with expenses, that the gift to the charity adjusts accordingly. It's always the same 10%. So it's simpler to have the fixed amount, but it requires a little more diligence to make sure that it's still the right amount, right? That it's not the charity's getting way too much in relation to the inheritance to the kids. So that involves a bit of planning. But from an estate administration, it's a fair point to say a fixed amount of money is much simpler. The charity probably gets it quicker. You just write a check. The most you would need is an acknowledgement that they received the check, right? You don't need them to sign off, and they're not going to be reviewing the accounting and all the actions of the executor along the way. So it's not likely they're going to hire lawyers or get into anything in relation to the administration of the estate. But if it's a percentage, they have a right to do it. So there's pros and cons, as you said. It's not a fixed amount is great and a percentage is bad. That would be a wrong takeaway from this, but there's some options there from the planning perspective. But if you're taking on an estate with a charity, developing a plan and making sure you're communicating regularly with them and keeping good records and doing the things you should be doing, and then getting appropriate legal and accounting advice along the way. And early on, as we suggested, would be some tips to take into account.
I think those are some great final comments, Gord. We'll leave it there for today. And we thank all of our listeners for watching us or listening to us wherever you are. Please feel free to subscribe, and we look forward to hearing from you next time. Thank you.